UN agencies warn of a famine in at least a dozen crisis spots worldwide. And IMF warns of a currency risks from the converting the Chinese loans from the US dollars to yuan. IEA projects global oil and gas demand will keep rising until 2050. Welcome to the Economic Bulletin, and we start off with the global economy as two UN agencies have issued a joint warning that millions more people risk famine in at least a dozen crisis spots worldwide, including Sudan, Gaza, Haiti, and Yemen. The World Food Programme and the Food and Agriculture Organization identified these areas as facing an imminent risk of catastrophic hunger. The agencies reported receiving only $10.5 billion of the $29 billion needed to assist the most vulnerable populations, citing crippling funding shortfalls that are forcing ration cuts and limiting food access. The warning comes amid global reductions in international aid, including significant cuts from the United States, previously the top donor to both the UN agencies under President Donald Trump's administration. The Bank for International Settlements has announced that the European Central Bank President Christine Lagarde is to take over from the Federal Reserve Chief Jerome Powell as head of two of the bank's economic groups in May next year. Powell will hand over the BIS's Global Economy meeting, which involves 30 top central bankers and its Economic Consultative Committee. However, the BIS did not say how long Lagarde's stint as chair of its committees will run for. And moving on to Europe, where the Status has revealed that the annual inflation rate in Germany fell to a 2.3% in October from 2.4% in September. After two consecutive increases related to service prices, the inflation rate dropped slightly in October. Energy prices decreased by 0.9% year-on-year, while food prices increased 1.3%. Energy and food excluded inflation rate was at 2.8%. Services prices rose to a 3.5% over the same period, while goods prices went up to a 1.2%. On a monthly basis, the inflation rate was an 0.3%. And France's central bank has forecast that the economy will grow slightly in the fourth quarter as high political uncertainty contributes to a slowing pace of expansion in November. Although it did not give a figure, the bank highlighted concerns over a crucial budget vote and a challenging global environment delaying major investment projects. The Bank of France also expected manufacturing and services to pick up in November, supported by the reopening of several core plants and preparations for year-end festivities, even as food exports fall due to the U.S. tariffs. Moreover, the National Statistics Agency has revealed that the Italian industrial output climbed a 2.8% in September from the month before, offering some hope to the country's long-struggling manufacturing sector. Data showed that on a weekday adjusted year-on-year basis, industrial output rose to a 1.5% in September. Both the month-on-month and year-on-year rises in September were the steepest in at least the last 2 years. The agency noted that despite the positive data for September, the outlook for the industrial sector is still cloudy, as the third quarter output was down 0.5% from the previous 3 months. And Finance Minister Jens Stoltenberg has said that Norway supports a European Union plan to use frozen Russian assets for Ukraine, but will not use its $2 trillion sovereign wealth fund as the sole financial backstop. Stoltenberg dismissed proposals that Norway's fund, the world's largest, should guarantee the entire 1.6 trillion crown plan. The EU is considering using frozen Russian assets for Ukrainian reconstruction, though some members have raised legal concerns. Norway's fund follows strict rules limiting annual government spending to its expected 3% real return. Bloomberg has reported that the International Monetary Fund warned Ethiopia and Kenya about currency risks from converting parts of their Chinese loans from US dollars to yuan. And both nations seek to cut debt costs. Kenya already saved about $215 million annually through a similar move, while Ethiopia is restructuring a $5.38 billion in Chinese debt after its Eurobond default. The IMF said yuan swaps may offer short-term relief, but could expose countries to exchange rate volatility. And Ethiopia's birr remains weak, while Kenya's shilling has stabilized after major losses in 2023. The fund urged both to balance cost savings with long-term currency stability. And for further analysis, we are joined from Hong Kong by the economist Benny Wok. Welcome, sir, to Qnews.
Hello.
Sir, can you tell us why is the IMF warning Ethiopia and Kenya about their converting their Chinese loans from US dollars to yuan, and what specific currency risks are we talking about?
Hello, thank you for having me. So I would say it is a very rare case for the debt countries to swap the currency from the major major currencies, that is the US dollar, to another dollar that is not the euro, not Japanese yen, not the British pound, but the Chinese yuan, which is not really freely trade around the world, even though you are seeing the Chinese yuan is getting popular among the world for the global trade. So I would say the risk for the Ethiopia and Kenya is, one is because it is not freely trade, that is, it could limit the use for the Chinese yuan for both countries, and also whether the China would forcing other debt countries such as Sri Lanka and other developing countries owing much debt to China, whether the China is forcing those countries to swap their US dollar-dominated debt in the Chinese debt. It is already it's quite popular among the West. That is, the China is using those debt, is forcing those countries to comply or bow to China for taking those assets into be their strategic assets for the China. So and of course another risk is because of the Chinese yuan is not freely trade. So that means the risk from the US dollar, the Chinese yuan, that is the risk is shifting from the unpredictable US trade policies to the PBOC, that is the Chinese monetary policies, that is whether the economic cycle of China then is now linked to those developing countries, and there may be the economic cycle between the developed countries and China may not be in the same cycle, then it would be another risk.
Let me ask you, Mr. Kwok, do you think the potential savings from the yuan denominated debt outweigh the long-term risks of the exchange rate volatility?
In short term, in the middle and short term, I would say the China, the PBOC, that is Central Bank of China, and it will still maintain a very relatively stable currency rate with the U.S. dollar because China doesn't want the Chinese yuan to be depreciate a lot. But I would say that is the risk to those debt countries. That is whether they are, of course, in the short term they could save the interest rate for the debt because the China offering some benefits for them. But the long-term risk to them, that is whether those countries have been preparing, already. I'm not sure whether they have prepared for their economies. Are they really prepared to be connected or linked to the cycle of the Chinese economy? Because if your debt is denominated in the Chinese yuan, that means the currency rate, currency risk will be linked to the Chinese yuan, and then it would be connected to the Chinese economy. And we all know that is the Chinese economy is getting declining or slow down quickly. And whether if what you're owning your Chinese yuan, that is okay, you're having the Chinese yuan, and you can only buy the Chinese yuan given the limited asset, and those asset is very limited. And it may be depreciate because of the Chinese economy is still getting need some more time to improve. Then it would be another risk for those countries.
Mr. Kwok, also, how could these conversions affect each country's, whether Kenya or Ethiopia's, overall debt sustainability and the financial stability?
If they are really determined to, I would say, to strengthen the ties, the trade and economic ties with China, and also if really China would wanted to strengthen its ties with Africa and the other developing world as well, and then of course the risk would be less because both sides are determined to have more trades, more economic activities. That means they are more willing to having more businesses among them. Then, of course, I would say it is relatively more stable for them to use the Chinese yuan to do the trade activities instead of relying on the U.S. dollar. But I would say that is it all depends on the status of the Chinese economy, and I think for many debt countries such as the Kenya, Sri Lanka, Ethiopia, they doesn't have much choices. They have to choose between, I would say, the West and China, and because these kind of countries owe so much debt to China, and I would think they got really limited choices. So that's why when you see news, that is because they just want to relieve some of the pressure of the interest. So they choose the China's offer to swap the U.S. dollar debt into the Chinese yuan debt.
Mr. Kwok, can you explain to us maybe the phenomena of why is Ethiopia's currency, the birr, more vulnerable to currency shocks rather than Kenya's shilling? And how might, we can say, the yuan exposure amplify those risks?
I would say that is amplifying. That is, I would say, okay, to those countries, of course, you have to look at what the industries that is, because these kind of countries, many of them do the exports with China, and they export many, for example, like raw materials to China. That is, I would say, the risk to them is for the risk for these two countries to the currency is they are really depends on the status of the China's economy. And of course, in the very technical term, that is whether the Chinese the movement of the Chinese yuan really, if the movement is very high, that is it appreciate or depreciate a lot, and of course it would affect those currencies for the Kenya, Ethiopia. It is, I would say, now you're seeing many people are saying that is try to just give up the US dollar to change to another currency because of the unpredictable US trade policies and also the weaponization of the US dollar from the Washington. But from the perspective of China, I would say Beijing does not have such, I would say, such strength and power to try to weaponize the Chinese yuan. Instead, Beijing really want to encourage more and more countries to use the Chinese yuan so that they could, I can't say replace, but at least to challenge the dominating power of the US dollar. So I would say the PBOC, that is the Central Bank of China, would try to stabilize the currency as much as they can. So that, of course, first is to maintain the Chinese economy, and also it could be a benefit for those developing countries, and especially those debt countries that relies on the trade activities with China. So it would be good for them. Yes.
I'm actually running out of time, but thank you so much from Hong Kong. That was the economist, Mr. Benny Kwok. Thank you so much, sir, for your insights. And now we're back to our news. And the U.S. Mint will strike its final circulating pennies today, ending over 2 centuries of production. Each 1-cent coin now costs nearly 4 cents to make. And the move follows President Donald Trump's order to stop what he called wasteful minting, a step expected to save $56 million annually. Existing pennies, about 300 billion in circulation, will remain legal tender, though cash transactions will round to the nearest 5 cents. The Mint will still issue collector editions and encourage the public to return stored coins to ease short-term shortages. Global stock markets showed mixed performance today, with gains in Europe and Asia contrasting with modest losses on Wall Street. And in Europe, Germany's DAX and France's CAC 40 both rose 1.13%, while Britain's FTSE 100 edged up to an 0.14%. In the United States, the S&P 500 slipped 0.15%, the Nasdaq Composite fell an 0.65%, and the Dow Jones Industrial Average gained an 0.67%. Across Asia, Japan's Nikkei 225 climbed an 0.85%, Hong Kong's Hang Seng added an 0.85%, and China's Shanghai Composite dipped an 0.07%. And on the international relations, China and Spain have signed a series of new agreements signed during King Philip VI's visit to Beijing. The agreements included a joint declaration to promote Chinese and Spanish language teaching, an MOU on economic cooperation and protocols for exporting aquatic products and animal protein to China. They also covered a regional animal disease zoning agreement and an MOU on food safety cooperation. For his part, the Chinese President Xi Jinping expressed his willingness to work with Spain to build a more stable, comprehensive strategic partnership, while King Philippe noted that the two nations have developed a strong, trust-based relationship. Deputy Prime Minister Bu Tan Son said that Vietnam aims to sign a new trade agreement with the United States soon as the negotiations continue in Washington. The deal is expected to maintain 20% U.S. tariffs on the Vietnamese goods, but exempt some products. Talks led by the Trade Minister Nguyen Hong Dinh focus on tariff exemptions, such as for coffee and the market access for U.S. cars and farm goods. Vietnam hopes to finalize the deal after a pending U.S. Supreme Court ruling on the Trump-era tariffs. Son urged the U.S. businesses to support the talks and back a proposed meeting between President Trump and Vietnam's leader, Thu Lam. And in India, the government data has revealed that the retail inflation slumped to a record low of an 0.25% in October, and driven by a sharp fall in food prices and tax cuts on consumer goods, paving the way for a rate cut by the central bank in December. Food prices fell a record of 5.02% year-on-year in October against a revised fall of a 2.33% in September. Vegetable prices declined 27.57% after a 21.38% fall in the prior month. And Guinea has inaugurated its $20 billion Simandou iron ore project, while announcing plans for a $1 billion sovereign wealth fund to manage the expected revenues. And the mine, which began production this month, is projected to yield 120 million metric tons annually, with a 75% of output destined for China. The government will channel mining revenues into the new sovereign wealth fund, set for launch in 2026 to finance infrastructure, education, and economic diversification. The fund aims to stabilize Guinea's budget against commodity price swings while supporting long-term development through the Simandou 2040 strategy. And in the United States, the House of Representatives will vote today on a stopgap funding bill to end the longest government shutdown in U.S. history. And the measure would restore food assistance, pay federal workers, and revive air traffic control operations through January the 30th. President Trump's support is expected to secure Republican backing, though Democrats strongly oppose the bill because it doesn't guarantee health insurance subsidies. If passed, the package would head to Trump's desk, finally resolving the 40-day shutdown that has disrupted government services and left hundreds of thousands of workers without pay. And in energy sector, the International Energy Agency now projects global oil and gas demand will keep rising until 2050, reversing earlier forecasts that anticipated a faster shift to clean energy. The updated outlook suggests the world is unlikely to meet key climate targets. Under current policies, oil demand is expected to reach 113 million barrels per day by mid-century and 13% above 2024 levels. While a peak around the 2030 remains possible if proposed climate measures are implemented, the IEA noted insufficient new national climate targets to ensure this transition. And OPEC has significantly revised its oil market outlook, projecting that global supply will match demand in 2026, marking a shift from its previous forecasts of a supply deficit. The change reflects expected production increases from the OPEC Plus and other producers, while the OPEC maintained its strong demand growth estimates. The new projection narrows the gap with more conservative forecasts from agencies like the International Energy Agency, which has warned of potential oversupply. The revision comes as OPEC Plus plans to pause production increases in nearly 2026. The government has announced that Britain will ban companies from providing shipping and insurance services for Russian liquefied natural gas exports. The measure, to be phased in during 2026, aims to cut off Kremlin revenue supporting the war in Ukraine. And the move aligns with the EU sanctions and goes beyond existing measures by targeting service providers that facilitate Russian liquefied natural gas shipments. Britain also pledged £13 million to help repair Ukraine's energy infrastructure. And that brings us to the end of our economic bulletin, and here's what we have been covering. UN agencies warn of famine in at least a dozen crisis spots worldwide. And the IMF warns of currency risks from converting Chinese loans from the US dollars to yuan. IEA projects global oil and gas demand will keep rising until 2050. And this concludes our economic bulletin. And don't forget to follow Qnews on YouTube, Facebook, X, Instagram, and TikTok at Qnews EG to stay informed. And thank you for watching, and stay tuned for more updates on Qnews.